Happy Thursday, everybody. Welcome to another episode of China Update, where we discuss leading political, economic, and geostrategic analysis on the world's #2 economy. My name is Tony. As you can see, I'm still on my vacation in Bali. I'm filming in my hotel room. Please forgive the informality of the filming location. It's going to be like this for the next couple of episodes, but hopefully we'll be back to normality from next week. Once again, this week we'll have fewer episodes than usual. This is Thursday's episode, and then there will likely be one more episode on Saturday, and that will round out the week's updates. Now we've a lot to cover, so let's jump in. First up, on Monday this week, a deadly restaurant fire in northeast China's Liaoning province claimed 22 lives and left 3 injured, prompting an urgent nationwide safety review just days before the May Day holiday, which have now begun. The blaze erupted noon at the Sanli Chuniang restaurant in the city of Liaoyang, according to state-run Xinhua news agency. Dramatic footage circulated online shows flames engulfing the 2-story structure. Firefighters arrived quickly, deploying 22 trucks and 85 personnel, and managed to extinguish the fire within 20 minutes. But not quick enough for the almost 24 dead within. Authorities have detained the restaurant's operator as an investigation into the cause begins. While the exact cause is still unknown, early reports suggest that strong winds and poor building design, including obstructed or absent windows in some private dining rooms, may have worsened the situation. In response, General Secretary Xi Jinping ordered a full investigation and emphasized the need for heightened safety vigilance nationwide. Premier Li Qiang echoed the sentiments, calling for stricter enforcement of fire safety protocols. The State Council's Safety Committee has taken the unusual step of placing the investigation under its direct oversight. A team from the Ministry of Emergency Management has been dispatched to Liaoyang to lead the probe. The incident underscores growing public concern and anger over fire safety in commercial establishments. The nation has seen dozens of high-profile fires in recent years, causing public anger and, in some cases, rare public demonstrations. As such, it is no surprise that Beijing has reacted to this recent tragedy the way that they have. They obviously see this as the sort of event that can trigger a wider political movement. Next up, Chinese investors are pouring into gold at an unprecedented pace, seeking a safe haven amid rising economic uncertainty driven by US President Donald Trump's trade war, fears of US recession, and persistent inflation. According to the World Gold Council, WGC, Chinese inflows into gold exchange-traded funds, ETFs, hit 70 tons, or approximately $7.4 billion in April, more than doubling the previous monthly record. Quote, "China is really in the lead now," end quote, said John Reed, senior market strategist at WGC. Over the past month, Chinese demand has accounted for more than half of all global gold ETF inflows, with the country's share of global holdings surging from 3% to 6% since the start of the year. Gold has emerged as a standout performer in volatile markets. After peaking above $3,500 a troy ounce last week, prices eased to around $3,300, still up 26% year to date. Local demand in China has pushed premiums as high as $100 over global prices, prompting the Shanghai Gold Exchange to caution investors to, quote, "make rational investment decisions." End quote. For these investors, however, these are their only rational decisions left. China's tight capital controls and faltering property and equity markets have left gold as one of the few appealing investment options. Quote, "It's just like when stocks rise and mum and pop investors rush in," end quote, noted a Shanghai-based broker speaking to UK-based The Financial Times, adding, quote, "People think buying gold is a sure way to make money." End quote. While global jewelry demand fell 21% in Q1 due to high prices, overall investment demand, spanning ETFs, bars and coins, jumped 170% year on year, leading the World Gold Council to sharply raise its annual forecast. This is a sign of just how concerned Chinese investors are and how few avenues they have left to pursue. As geopolitical tensions persist, gold's allure as a hedge appears to be stronger than ever. And speaking of geopolitical tensions, of course, the world is going through tremendous change. We're following one of the major stories of our time, that is the emerging US-China Cold War, here on China Update. Indeed, next we're going to look at updates in the US-China trade war. If you want to be on top of these developments as we live history, maybe consider subscribing to China Update, hit the bell notification icon, and you will be. If you're getting some value from today's episode of China Update and you appreciate me putting out this extra video on my vacation, it's a huge help if you can hit the like button. Thank you so much. Next up, as tensions deepen in the US-China trade war, Beijing is pursuing a dual-track strategy, publicly holding its line against pressure while quietly taking steps to mitigate the fallout at home and abroad. China's Ministry of Foreign Affairs said on yesterday, there had been no official consultations or negotiations between the two sides, that is Beijing and Washington, in the past 24 hours regarding the sweeping US tariffs. Yet a cryptic post by state-affiliated CCTV's Yu Yuan Tantian claimed the US had, quote, proactively reached out, end quote, through multiple channels. Quote, unless the US takes substantial action, end quote, the post added, quote, China has no need to enter into talks, but Beijing is willing to use such outreach to better understand US intentions and gain leverage, end quote. Behind the scenes, however, Beijing is quietly softening its stance. UK-based Reuters reported that China has created a whitelist of US-made goods exempt from its 125% retaliatory tariffs. While China has already excluded some critical products like microchips and pharmaceuticals, the new list suggests a targeted effort to protect industries and companies vulnerable to price shocks. Officials are also inviting firms to submit applications for exemptions, offering some relief amid the rhetorical standoff. US companies are also adapting. Walmart Inc. has resumed orders from Chinese suppliers after a brief pause following the tariff hike. According to Chinese financial media outlet Caixin, the retailer is absorbing some of the added costs itself, while other duties will be shared depending on contract terms. Meanwhile, the trade conflict is pushing larger institutional players to hedge. Bloomberg reports that China's sovereign wealth fund, China Investment Corp, is reducing exposure to US private assets, especially in real estate and infrastructure, amid fears of longer-term decoupling. It has reportedly begun seeking buyers for over $1 billion in US-based private equity holdings. On the corporate front, fast fashion giant Shein faces significant headwinds. The looming closure of the US de minimis tax exemption will leave its goods subject to 120% tariffs. With a third of its $38 billion annual revenue coming from the United States, Shein is now considering shifting production outside China, including to Brazil and Turkey, though the company's vast China-based supply chain would be difficult to replicate elsewhere. Beijing, however, is reportedly pressuring exporters like Shein not to move operations overseas, fearing the long-term erosion of China's manufacturing base. The very thing that has pushed Washington to introduce some of these measures against China, and exactly what Washington said would happen if it put barriers between its massive market and China. Industry insiders say Shein is in a holding pattern, watching geopolitical developments and tariff negotiations closely before deciding on restructuring or delaying its IPO plan in London. Shein has already hiked prices, some by as much as 377% on select products, though it has tried to shield consumers from significant increases on core apparel. Its ad spending in the US has also plummeted as the company recalibrates its strategy in the face of rising costs and regulatory uncertainty. As Washington and Beijing remain locked in a public standoff, both sides are quietly making moves behind the scenes, each trying to shape the battlefield before the next round of high-stakes negotiations. And finally for today, China has unilaterally lifted sanctions on members of the European Parliament and their families in what is widely seen as a strategic move to mend relations with the European Union amid rising transatlantic tensions spurred by US trade and foreign policy shifts. Announced this week during a closed-door meeting of senior European Parliament leadership by President Roberta Metsola, the decision marks Beijing's most concrete gesture yet in a renewed diplomatic charm offensive toward Europe. The sanctions imposed in March of 2021 in retaliation for EU measures over alleged human rights abuses in Xinjiang had frozen dialogue and effectively halted ratification of the Comprehensive Agreement on Investment, CAI, between the EU and China. The lifted sanctions apply to sitting members of the European Parliament and members of the Parliament's Subcommittee on Human Rights. However, sanctions reportedly remain in place on several prominent figures and institutions, including academics, national MPs, and influential think tanks such as Germany's Institute for China Studies. Beijing's hope may be to revive discussions around the long-stalled CAI, a sweeping investment pact agreed in principle in late 2020 but shelved by the European Parliament following the sanctions exchange. Yet despite this overture, a quick restart of CAI ratification appears unlikely, given lingering concerns in Brussels over China's human rights record and strategic alignment with Moscow, not to mention its many trade issues. The move comes as the EU finds itself caught between intensifying rivalry between Washington and Beijing, with the Trump administration's escalating tariffs and assertive policies fueling a reassessment of alliances in Europe. Though as unpopular as Washington is in Europe these days, Beijing isn't exactly doing much better in European capitals. Whether China's latest gesture will gain traction in Brussels remains uncertain, but it signals Beijing's intent to recalibrate its relations with Europe, seeking to limit Washington's influence and reinstate channels of economic and political cooperation. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. It's a pleasure to be able to continue these episodes while I'm here on vacation. I can't do it every day, but it's good to get a few out during the week as we continue our coverage of these major trends and developments. I hope you enjoyed it. Have a wonderful Thursday, and I will see you for probably the last episode of China Update for this week on Saturday. But for those who watch Market Update, my other channel, there will be an episode of Market Update tomorrow. So I will either see you tomorrow or on Saturday.